It's probably as expected, and I think the market will focus on that wage pressure that she talked about, inability to fill jobs. So that's where we'll end up focusing. I don't think it's a surprise that we talked about tariffs. In fact, the street's been counting the number of times tariff has been written into the Beige Book reports. For the record, May was 22 references. It sounds like it'll be more than that. So again, I think the things I would want to see as a follow-up to these numbers, since they were as expected, is consumer spending, as well as demand for loans. Those are two things that are going to come out of this type of pressure in actual effect on markets and earnings that I wait to see.
You know, we already heard from Jamie Dimon in his earnings conference call that trade is impacting the psyche of clients, but not their action. So have we gotten the answer from the financials? Can we put it behind us? The trade is not going to sort of curtail the business activity, or is that still very much to be seen?
I think it's still to be seen, because you've got a market that is very sanguine, right? And I could argue that, you know, maybe it's complacent volatility and it's low in both equities and bonds, right? But I would argue that there's very little economic risk. This is the one everybody's focused on, so I think there's going to be a continued push on how this plays out. Personally, I don't think it's going to be that big a deal.
Volatility is decreasing here, but it's increasing in emerging markets, and all emerging markets are not made equally. But with that increased volatility, does that become opportunity for you?
Absolutely. We're huge buyers of emerging markets. You have to be select. We like Asia better than LATAM, just because the picture's clearer in Asia, if you will. We're still very, very big on China. But you got to look for the idiosyncratic risks, and this is where I think kind of the active management play versus the index, which is going to catch all the heat for all of that noise around trade, will have an effect.
How do you invest in China? I mean, for years it was actually almost physically and financially impossible for a U.S. individual investor to buy a stock in China. They bought Hong Kong, they bought a proxy. What are you doing, actually?
Well, actually, UBS was the first to get a fund license in China. We have a number of onshore funds in both fixed income and equities now in China. You've seen the opening of the indexes and the global thing, which is why I would argue maybe separate out China as a separate sleeve within an emerging markets portfolio, because it is very different, and the index isn't going to capture the growth that you're going to see in some of those individual names.
So are you invested in China, or are there other places in Asia within emerging markets that you like?
We are absolutely invested in China, for sure. Yeah. Elsewhere in Asia, it's a little more idiosyncratic. Long-term, we like India, for example. Not so much short-term, but long-term, we like India. And the other countries waiting to see how China falls out in the trade war, which, again, to me is a knee-jerk reaction as opposed to a real fundamental look.
Historically, when interest rates go up, emerging markets go down. Mm-hmm. Do you think interest rates aren't going to go up, or do you think that relationship is no longer as true as it used to be?
I think that relationship is no longer as true as it used to be. I think interest rates are going up, albeit gradually, but emerging markets is very different than it was just 10 years ago, right? The current account balances are different. Central banks are more active. It's a lot more EM to EM trade flow in there. They're not as reliant on U.S. dollar financing. Across the board, it's a very different market.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.